This week on the VC React podcast, a $48 million Series A for Alaan. Corporate expense management has officially become a red ocean in MENA, with Alaan, Cashew, Pluto, Nuqudlet, and others. Is this going to be a winner-takes-all game, or will there be vertical domination? And can these companies be challenged by neo-corporate banks with similar services like Bricks, Mercury, and Revolut Business, who is coming to the region? Or will they evolve into banks themselves? Salasa wants to be the AI-powered logistics backbone of e-commerce in MENA. But is AI really a game changer in e-commerce fulfillment? How is AI helping here? And how is Salasa eating Armex's lunch? Wuilt ditched the ARR model, went fully free in Egypt, and onboarded 20,000 merchants. Is this genius or desperate? Would this challenge Salah and Zed? Also, are we entering a new era where the product is free again, with no subscriptions, but monetized through Fintech instead of advertising? And finally, Afaq Capital just bought an entire VC portfolio in a landmark secondaries deal. Is this the beginning of a real liquidity market in MENA? Will secondaries outperform primaries? And where are the secondaries dedicated funds in MENA? Hi, everyone, and welcome to a new episode of the VC React podcast. Every week, we bring you insights and reactions from top VCs, LPs, and angel investors reacting to the latest news on startups, VCs, and investment rounds. This episode is brought to you by Octa, the AI-powered finance automation platform built for modern businesses. Managing receivables is not one task. It's dozens of repetitive ones. Correcting invoice details, updating PO numbers, following up on payment status. It's operationally critical, but painfully manual.
Octa changes that. It helps you automate your financial operations, starting with accounts receivable, so you can focus on what you're actually good at, growing your business. From contract to cash, Octa's AI agents handle everything: invoice creation, reminders, dispute resolution, payment tracking, reconciliation, even financing. You don't need to learn how to use Octa. Octa learns how you work. It adapts to your SOPs and existing workflows to get the job done. Finance teams at Careem, Lean Technologies, and Outgram rely on Octa to reduce admin time, speed up collections, and unlock cash flow.
If you've heard of them before, you know that they used to say 100 companies use Octa. The number is now 500. They are moving fast. And that kind of growth only happens because the problem is real and the solution actually works. Automate the finance work that slows you down. See how at weareocta.com. Let's jump into it with our amazing guests for today. Almajthoob, partner at MEVP. Shalakany, venture partner at Atypical Ventures. And my co-host Jamie Lane from FWDstart. In the video description, you can find more details on our guests, their LinkedIn profiles, and links to the company's websites. Our weekly news are brought to you by FWDstart, a twice-weekly newsletter that breaks down what's happening in the MENA startup, VC, and tech space. Hi, Jamie. What do you want to start with today?
We'll start with Alaan, which you mentioned at the start, which is seemingly becoming a more hyper-competitive space with every month that goes by. As you highlighted at the beginning, you've Casio, who raised a round relatively recently. Paymo raised, I think it was 7 million back in November. You've Pluto, who raised a pre-Series A relatively recently as well. But 48 million, it's a pretty colossal Series A round.
Series A.
Yeah, it's pretty huge. So look, led by PXP Partners, formerly Afaq Capital, India and Southeast Asia. You have participation as well from 885 Capital Founders, Y Combinator, and a whole host of angels of prominent persuasion, sort of take your pick in terms of ecosystem who's who, included both primary and secondary in this particular raise as well. So for some context as well, I mean, the company is only 3 years old. It was founded back in 2022, ex-McKinsey. We won't hold that against them. Corporate cards, embedded AI finance agents, which is interesting. We might double click on that in a minute, exactly what that entails. I was doing some reading, I think, in terms of an interview that their CEO Parthy did, and in terms of what he described these agents as, essentially They handle the heavy lifting behind the scenes, so reading receipts, matching them to transactions, verifying details, extracting things like VAT information. So for the end user, essentially, it's a kind of a one-click expense submission process. You just upload the receipt, and the AI takes care of the rest. In terms of progress to date, used by 1,500 companies, G42, Careem, Tabby, etc. They expanded into Saudi relatively recently as well, so there's doubling transaction volumes there month over month for the past 6 months. So to your point, Ahmed, it all begs the question as to, is it a winner takes all market, or is it not?
Is that?
Yeah.
Yeah. And when you look at, Alaan versus Cashew versus Pluto versus Nuqud left, and by the way, Cashew almost
20.
raised $20
Yeah.
million so 2 months ago, and they are all targeting Saudi. Are we seeing a category where really one takes all, or takes most maybe, or can be there some support for multiple strong players with each focusing on a specific vertical or a niche in the market? What do you think?
I think that, first of all, it's great news for the region that we're able to raise, I think, the largest Series A in the Middle East, or one of the largest. So that's a really good sign for the MENA region. I started using sort of the US equivalents quite a few moons ago. So Brex, Mercury, and Ramp, I think, is kind of the latest. I think their last raise Ramp was 200 million or something. So, traditionally, or not traditionally, in the US, these folks spawned to challenge the horrible interface of B2B banking that was kind of from traditional service providers. And it's completely changed the face of the game. I've personally used these products, and they're still way ahead of what traditional banks are trying to provide. So there is a real problem they're solving for. And the fact that we have so many that have spawned in our region means that the problem is super acute here. I have to say, I share also that view that it is very crowded. I don't think any SME or enterprise will have multiple of these products. So I think that this will probably consolidate into 2 or 3 players.
Yeah, makes sense. Ali, what do you think?
Yeah. I guess it seems like we're in expense management wave 2.0, right? So back in like 2021, all of these companies were raising at that time, very large seed rounds, let's say, right? There were a lot of different players. They were all raising a lot of huge seed rounds. And a lot of talent, for whatever reason. Sometimes there's certain sectors, there's certain business models that a lot of talent, and you always get this like mix of an ex-McKinsey guy, a business domain guy, a sector experience guy, or girl, of course. And it kind of signals to the market that this is a very hot market, and more VCs come to it, and more talent also comes to it. And if you ask any of these, management companies, oh, you're just like the other one. Yeah, but we thought about it first, or we didn't know that there are other players and, working on the same model. But of course, what supersedes all that is, of course, Brex and Ramp and the US companies. And Brex, of course, before COVID, back in 2019, was kind of like one of the crown jewels of the fintech world, especially in the American market. Now we're getting a whole new wave of expense management players raising, their Series A rounds, 3, 4, 5 years since their initial seed rounds. I think what we're seeing at this stage is, number one, right? Maybe we had like 20 companies. Now we're coming down to maybe the top 5, 6 that are raising these large rounds. So that's number one. Number two, I think on the regulation side, there's much more clarity on what is required from the expense management players, what are the licenses that are needed. UAE and Saudi Arabia has done a lot of progress in terms of launching new PSP licenses, which gives a lot of clarity to the expense management players, what licenses they need to do, how they can onboard, how they can actually issue the cards, how, the scheme memberships, all of that. So I think there's over the past 3 years, there's some significant improvement over there. And then also, I think one of the latest is AI, right? And how can we integrate AI in towards all of the expense management activities or expenses? Now, I think when you ask about, is this a one winner take all, or is there room for multiple players? I think if you talk to any of these expense management companies, they want to capture the whole value chain of the expense management, part of the business, right? So whether you're talking about, it's not just, expense cards for your travel, it's for inventory, it's COGS, it's overhead, it's online subscriptions, it's also payroll, And then, of course, on top of that, you could do a lot of different financing solutions to make sure that you're managing your cash. And of course, cash flow to SMEs is also one of the biggest challenges, to make sure that they actually sustain their business even if they're profitable. Then if and then adding AI on top of that, obviously you want one comprehensive ecosystem to give you the full value to these SMEs or startups or even large enterprises. So actually, I definitely agree with Ali as well that probably you'll find maybe 2-3 companies, based on what the playbook seems to be, is that you actually want to, capture the whole value chain of the expense management part of the business. And it doesn't make sense to have multiple expense management or online, AI, CFOs, let's say, that manage the whole thing. But also at the same time, typically when it comes to fintech, banking services and financial services, it's rarely a one winner takes all, right? And every corporate, every individual typically has multiple bank accounts and multiple, financing facilities from different institutions.
So let me stay with you. You mentioned they are trying to capture the whole value chain. Brex, you mentioned Brex. Brex started as a corporate card company and then evolved into a full-fledged bank.
Yes.
Right. Mercury, on the other hand, started as a bank, but then they added all of these services like expense management. So if you open a bank account with Mercury, you don't need Brex or any other expense management system. There's a new company also called Every.io, which has everything, like everything you can imagine, from a bank account, from expense management, taxes, accounting. What's the future of these companies in MENA region? The local ones, and can the international ones come and compete here as well?
I think probably the direction of travel will be closer to what Every's doing. So I think that to differentiate yourself, you're going to have to capture more and more services that are wanted by your customers. So expense management is probably a very strong beachhead to kind of capture customers, but then you need to stay competitive and add more and more features and services, of which there are many. I mean, the reality is that especially SMEs in the region are very underserved, and they have a lot of problems that need solving. So well-capitalized folks that can actually provide those features is a good thing. And I think that probably there's a lot of adjacent fintech B2B SaaS that's being developed also in the region. So who's gonna kind of merge with who, or are they just gonna build internally? That is still a question mark. But I think my personal view is that in order to stay in the lead, you're gonna have to add more and more adjacent services.
I think, I mean, I think if you take a look at the market, you'll find, I think there's some players that do very well in Saudi, some that do very well in UAE, some of them that have a very cross border portfolio of clients. Some of them are doing very well with SMEs. Maybe some of them are doing much better with enterprises.
Okay, let's double click on the AI agent, the AI finance agent. What does that mean? Can you kind of try to speculate what that means?
I personally haven't seen, as I said, that product. My imagination is that there's a lot of manual processes still in the kind of financial operations side of things, so trying to ease the burden. So the front-facing person probably using this product, especially as you grow as a business, is going to be on the finance side. So either CFO, financial director, or maybe finance manager, and they will have a lot of still manual processes. So I think being able to integrate AI into easing that burden is a quick gain, but there is a lot of other agents trying to do that are not starting from the expense management side, kind of drilling downwards. They might be already internally and kind of pushing upwards. So we've seen a lot of other solutions that are doing that, but not starting the way that it has started here. So I'm interested to see how it works and whether it can compete with other agents going forward.
I think, the role of these AI agents, taking a look at the expense management or the role of the CFO or the financial controller, you could see a lot of, areas where this AI agents could add value, right? So talking about how can you handle excess cash, get better returns on this excess cash, better deposits. If you're struggling with repayments, right? Or payables or receivables, right? So how can you make sure that you're getting receivables better on time? How can you make more better advantage of the discounts between, let's say, financing rates and the discounts that you could get on, invoices if you pay early? How can you make sure that payments are always done on time? How can you make sure that maybe you get better facilities, for working capital or for CapEx? And once you have a full comprehensive overview of all of your different expenses, from petty cash to payroll to, to purchases to inventory, you could get much better efficient management of your finances and the growth of the company and how you can manage the growth of the company. Now, the question, I think, also is maybe a broader question about applied AI and how do we foresee AI being implemented across these different business processes. And what you'll find, I think, is probably you'll find maybe some AI companies or, some startups that are, let's say, software plus AI. They do software that is very strong in one certain element, and then they have an AI component that, kind of adds more value and benefit to the client. And then you have these generic AI, business process automations where they go to the large enterprises, they figure out what are the different business processes and how can we create AI agents and automate it using machine learning and AI. And then also, on the other hand, AI is just, the barriers to entry is becoming very low where you have, vibe coding and companies such as Lovable and Replit where you could create very, very customized, tailored AI agents and bots that are extremely suitable for your own company. And how do we foresee AI, taking shape and which companies and business models are, let's say, quote unquote, VC backed or VC plays and which ones are not? These are all questions that we're also trying to figure out ourselves. But I think what I like about this at this stage, at least, if you have AI agents that are completely fine-tuned for certain specific businesses, for certain geographies that are well aware, you also have a unique set of data that, you're getting, let's say, from your own businesses, and what are the local payment schemes and local finances, and what are the local discounts, and who are the local suppliers, and what kind of payment terms do you get, and then if you could fine-tune these AI agents for all of this for these clients that they're serving. I don't know. I mean, at least for the next couple of years, I think it's quite exciting. But, in the long run, that's also another question about applied AI and how would it manifest in the long run.
It's a very complicated operation. And I think, AI will definitely simplify a lot of that. We'll talk more about AI, but in the e-commerce fulfillment later on. But for now, almost all of the VCs in this round are not MENA based, right? They're either from India or the US. But we have Arab founders or MENA-based founders who are participating in this round. Any reactions to this?
Firstly, I think it's really great that we're seeing more and more like founders investing in other startups. This has kind of been, let's say, a growing trend. It's always happened, but I think in the last few years, I've been seeing more and more of those folks on the cap table. So it's a good sign. I think some of those are also customers. So it's a good sign if your customer also ends up like taking an angel investment back. The fact that all of the investors are, or mostly are not led from the region, well, it probably reflects also on the size. So the size is definitely outsized. But I would usually want validation from kind of a regional VC to do that backing. But I guess they were so confident in this one that they saw something that maybe the others didn't. But it was a bit of a question.
Yeah. It seems that the region is becoming one of those emerging markets that everyone is looking at. Even international VCs are investing in companies targeting this region. Ali, what do you think?
Yeah, I mean, as my colleague Ali has also said, I agree 100%. Having Peak 15 still active in the region, further signals. I mean, but by the way, a lot of these international VCs are also backed by GCC-based LPs, and it's not like that they are completely strange to this sector. And then, it's a big, it's a big round. So, bigger pockets. You have a lot of global VCs that probably have bigger pockets, and I think also within expense management, the sector is just. There's a lot of different players, and I think if you talk to a lot of the regional VCs, they already have, some exposure in one player or another. So that's also another part to it. So it's not like there's a huge pool. If you already have like 3-4 other expense management players that also received a lot of funding from local VCs. And I don't know. I mean, there's a lot of different factors that play into this.
Yeah.
But overall, positive signal, the confidence in the market and from regional and local and global, sorry.
Yeah, I know, Jamie, you stressed on the fact that there was primary and secondary, but let's leave the secondaries until we discuss Afaq, and we'll talk about direct secondaries and LP secondaries then. Let's move to the next story, Jamie. What do you have for us?
Yeah, what Series B funding gap? Never heard of it.
Okay.
Seems like every other week now, which is fantastic. Obviously, needless to say, without being facetious.
Last week we talked about Series B, and today we have another Series B.
Exactly. Look, this time around, it's Salasa, as you alluded to, Ahmad. We're embedding AI into the e-commerce fulfillment side of things as well. So it's 30 million Series B, led by Afaq Capital, with participation from SVC directly as well, Wide Ventures, 500 Global, Al Sulaiman Group, and other strategic investors as well. Takes total capital raised to 40 million. Previously raised 8.6 million Series A back in 2020. So it's been a while since the last raise, but they weathered that crazy storm. It seems to have emerged strongly on the other side. Founded back in 2017, it was a traditional kind of fulfillment company in Saudi's kind of e-commerce logistics space. So what you expect, your kind of warehousing, shipping, inventory management, last mile delivery, that kind of thing. It's fulfilled and shipped over 50 million products, I think, since inception. More than 1,000 merchants on site, like your Noons, Amazon, etc. Ecosystem includes, like, it integrates with Salasa, Zage, Amazon, Shopify. Carrier partnerships are like your Aramexes, DHL, Saudi Post. In terms of, I suppose, what they're going to leverage this particular 30 million for, it's going to be to expand their fulfillment centers, dark stores, and also investing heavily in AI technology on the sort of predictive intelligence and automated operations side of the logistics network. Small bit opaque as to exactly what that sort of encompasses and entails, but nonetheless, it's obviously great to see a Series B round of this size for the ecosystem and look at the continued momentum.
Definitely. And hey, logistics has been always
Yeah.
one of MENA's pain points in scaling e-commerce. So we've seen so many others trying to do this, including Aramex. And there's other ones like Isnad, Zaji, Thabit, so many, and so many smaller ones in Saudi. But is Salasa finally cracking that layer, or is it still too early to call? As a VC today, would you rather back a logistics player trying to become a tech company, or a tech first company trying to build logistics from scratch?
I think this story kind of reminds me of, like, it takes 10 years to build a overnight success. I think
No, yeah,
they started in 2017, and today, we're talking about them like, wow, it's such an amazing, but it's been a long journey. And I think, as you said, there's been a few pivots. The trend for e-commerce sales in the region is still growing massively. So the infrastructure around it needs to be done. I think whether it's by a traditional player that's, kind of really boosts digitally, or the other way around, it's all about, these are very slim margin businesses. And so you need to be always investing to increase margins, either by operational efficiency, using technology. And I think a lot of the technology here would be like more robotics. So that's also an interesting angle to be able to really scale and accelerate this business. But they've obviously they've done a great job. I think it's good for the region. E-commerce really empowers so many SMEs, which is still the backbone of these economies. And I think that this will really empower them to kind of take their businesses to the next step. So I'm very excited by this job personally.
Yes. Before I move to the other Ali, let me stay with you here, Ali. They're expanding into bonded zones, cross-border shipping, dark stores. That's capital intensive, right? Can this model scale profitably? Or do you think they risk becoming a logistics company with a tech wrapper and just end up like any other big corporations trying to do that?
The way I look at this is sort of a bit like Amazon at the beginning, right? If you take Amazon at the beginning, yes, it had a great customer service. Yes, it had a great interface, but really the backbone was operations, fulfillment, right? I think that today it's still operations and fulfillment. That is really the backbone of that side of the business. Of course, Amazon has become, gone into many, many other facets, and Amazon is still one of the fastest growing tech businesses on the planet. So in the past, and I've been investing for 15 years in the region, I would just say that we wouldn't have the capital to continue backing CapEx heavy businesses. But today we have that. I think that they have put their money where their mouth is, and back this is really good. It will not be an easy journey because, I said, the margins are very slim, but I think this is one where if you dominate the market, you can really kind of become a very, very big business, a very solid business as well. So,
Ali?
Yeah, Salasa was one of the first companies that actually enabled, storage, integration with the e-commerce, integration with the couriers, with the, last mile delivery companies, especially for the, newly entrants to the e-commerce world, whether it's individuals or SMEs, or small retailers. So this is a company that from the get-go always looked at itself as, yes, there's happy CapEx infrastructure, but also technology integrations with the local e-commerce infrastructure as well, or e-commerce platforms. before COVID and after COVID, e-commerce penetration continues to grow very, very rapidly. I think in the MENA region broadly and Saudi also specifically, SME e-commerce continues to thrive and grow very, very rapidly. And Salasa is one of the companies, along with the likes of Zid and Sella, that actually provide the infrastructure for all of these new entrants. And now with AI and robots and robot technology and storage management, and there's a lot of, you can go to China, there's a lot of different service providers that could provide you with a lot of different solutions, but of course you need also local implementation and local integration. I don't know. I mean, Salasa, I think, is one of the pillars, especially for SME e-commerce. And this round is just, I think, further continuation of what they've been trying to do. It's not easy, of course, and they're definitely one of the major players, I think, in Saudi. If you're thinking about, okay, where can I store my stuff? If I'm looking to sell, Salasa is definitely one of those that come to mind. And I'm not mistaken, they also have a very good operation when it comes to large enterprises and large e-commerce stores, where you could always rely on Salasa as a 3PL from that regard.
As we're discussing this, I remember a video by Amazon Fulfillment Center where it's like robots running the whole show. There's no humans involved. I hope that Salasa will build something similar and show us videos of that soon. Let's move to the next story today, Jamie.
Yeah, let's talk about Wuilt. Am I pronouncing that correctly as well? Anyone have any?
I think it's Wuilt, like it built, but with a W instead of a B. So Wuilt.
Gosh, I was like, is there some sort of obscure pronunciation which I'm going to butcher and be embarrassed about again after the fact? But yeah, this is interesting. And you mentioned this at the top, Ahmad, that it's a pretty sizable pivot, and they've surrendered what they say, I think, is hundreds of thousands in ARR to move to this sort of free model, whereas previously it was subscription based. In terms of what Wuilt do, it originally started as a sort of Arabic language website builder. So look, I think self-explanatory, very easy, build it in 5 minutes, raised a kind of 500k plus seed funding a while back. And then, in April, decided to make it completely free, and they've gone down the merchant acquisition route. And since then, they claim that about 20,000 plus merchants have joined. So in terms of how they're monetizing now, you've Wuilt Shipments, Wuilt Pay, and Wuilt Wallet. It's planning to take its free platform to the UAE as well in Q4 of this year, followed by other GCC markets. And they also mentioned Turkey as well in early 2026. And I should mention, because I don't think I have, that they've just raised 2 million in order to do this. So you have investment from Flat Six Labs. I'm unsure if that's Flat Six Labs or they've rebranded now.
My understanding is that they created a new venture fund. So there's still Flat Six Labs and Ventures.
Yeah. It's the accelerator components is remaining Flat Six Labs, and I think it's F6 Ventures is sort of the
venture fund,
the sort of the follow-on vehicle. So
but
look, when it was announced, it was Flat Six Labs. So that's I'm taking it from there. Your participation.
I think they have now the Flat Six group. So there's the Flat Six.
Do you know what? That's easier. We'll go. It falls under the umbrella of the F6 Flat Six group in order to maintain correctness. But what do you think, guys? If a portfolio company comes to you and says, "Hey, look, we're surrendering hundreds of thousands in ARR, and this is the direction we're going," what's the reaction?
Look, I saw Wuilt when they first pitched, I think it was 2019. I think they were trying to be like the kind of Squarespace, Wix, but Arabic. So the promise was you can build an Arabic native website in 5 minutes. And look, it was an interesting proposition. At the time, I didn't think that they could actually compete. So yeah, that was kind of, my view. And I think they've now pivoted. Obviously, a startup pivoting is a very big decision, especially when such a, your also there's a big trade-off financially and commercially. You usually don't do that if you're already killing it in kind of your original direction. But yeah, I think it's a very brave move. Not for the faint of heart. I'm sure their investors, their initial investors also, but they're probably happy also with the 2 million raise, which is a great sign for them. And I think for the Egyptian ecosystem, which is kind of been slowly but surely doing better this year. But yeah, so I guess now they're trying to be like a Shopify equivalent, but kind of more integrated. And again,
that's why I'm comparing them now to Sella and Zed, because they're doing something similar. Yes. But hey, it's free. Create your own shop here for free, and we will monetize through the payments, the other transactions?
So I invest also in brick and mortar businesses as an angel investor, right? So, but we obviously have a digital kind of angle to that. So e-commerce is very important. Still, Shopify today is the market leader in Egypt because the quality of their offering is really, really great. But there is a bit of a pain point in terms of some of the integration which is localized, like payment processing and so on. So I guess solving for that is not a bad thing because it's not an easy thing, especially if you're not a very sophisticated seller, trying to do like payment processing integration and making sure everything works properly and, to make sure the customer service is really top notch is not easy. So the fact that they were able to onboard 20,000 is a good sign, but this is also a quite competitive space. I have seen a lot of other Shopify-like startups rise in Egypt, and they've kind of hit a bit of a ceiling. So that's my concern. But again, happy with the raise. It's a good sign for the market.
Yeah, I mean, web page building, right, or web page builders or platforms have been around for a very long time. It's a very competitive market, and every year they just get better and better. I mean, long gone are the days where just having strong Arabic support would bring you a lot of customers. I think Wuilt was one of the better ones, especially in Egypt, that is with a very strong user interface, and they were acquiring a lot of, let's say, if I'm not mistaken, like professional service companies and healthcare companies, and they wanted a strong Arabic presence with a strong brand and strong good website, and Wilt got a lot of traction from there. But if you take a look at all the web page builders and the e-commerce and the web store builders, ultimately it's the whole value chain, right? It's logistics, it's taking good photos of your inventory, integration with your ERPs, inventory management, return logistics, shipping, storage, using AI for better marketing and predictive analysis. So I think what obviously Wilt needs to do, and it's a strong uphill battle, but they need to capture as much companies as possible. And then once they can capture them, they could add much more value from the whole ecosystem or the whole value chain of e-commerce. And then that's where they could actually charge. But being a pure web page builder, it's very competitive. There's a lot of pressure on pricing. And especially if you're operating in the Egyptian market where price sensitivity is very, very, very tough. Zid and Sella, what really makes them succeed in Saudi is the whole value chain, right? It's the integration with the local photographers, local marketing agencies, local, logistics, local payment gateways, integration with the local ERPs. And so it's, if they can get that in, let's say, Egypt or in UAE, or in Saudi, the value proposition becomes much stronger. And then the ability to actually, charge and the defensibility of these charges or the revenue becomes much more better. We'll see. And hopefully,
more justified.
Yeah.
So let's take a step back and think abstract a little bit. We've kind of come full circle here.
Yeah.
First, product was free, and the companies used to monetize by ads. I'm talking in general, not specifically this company. Product was free and monetized by ads. Then we all had to pay subscriptions to get the product clean without the ads. And now it's back for free. But the monetization is happening not with ads, but through fintech or embedded fintech, payments, shipping, wallets, etc. What does that say about where the real value sits in tech today? Is product just a gateway now, and infrastructure is the new business model? What do you think?
For me, I think that customers today are becoming more digital savvy and they really want to only pay for value. So if that means that your entry product needs to be free to be able to demonstrate the value of that product, but then you can charge for those that actually add value, which I think is the way that I would kind of describe this, which is just getting onboarded doesn't mean anything. But if you want, payment processing, you want fulfillment, you want this, I'm willing to pay for that because I know the value, then I think that's all good and well, right? I think even for some CRM systems, you might find like a very low entry point just to kind of show you the power. But then they will say, hey, if you want to really get the best out of this engine, then you've got to pay. And sometimes you got to pay a lot. It's so I wouldn't compare it with the sort of you are the product, like kind of where advertising was, they would use your data and basically getting your data was why they would give you the free product. For this one, I think the shift is more like, okay, if we charge them something small, it's meaningless to us. We'd rather see that as CAC. To get them on the platform and then monetize with something that actually is more meaningful because customers today want to see value.
Yeah, I think, there's two things. Like, you could always take a look at a startup individually, right? And most likely every startup has tested a freemium model, right? Okay, we could acquire a lot of top of the funnel interest, but can we convert them into paying, right? Or maybe we could charge upfront, and that kind of pre-qualifies my leads into serious leads, and the conversion becomes much better and become much more efficient. And every startup is being torn between both sides every single day. And of course, you have the market dynamics. If it's something that is extremely commoditized, right, and where a client feels that I could get the same thing with a lot of different clients and I don't have to, or service providers and I don't have to pay. So obviously that is an uphill battle if you're trying to acquire them, right? It's I think ultimately as a startup, what you want to think of, okay, I mean, first off, it's not about having a minimal viable product. It's a minimal lovable product, right? Then you want to have a product that as soon as the client tests this or tries it, they fall in love, right? They reach that moment of delight. And then as soon as you reach that moment of delight, then you got them hooked. And then that's when you could charge them. If you feel like you could start off with a freemium model and you could see clear conversions and you could see that, that delight, happens with the client, and then you could justify that, that charge, or you feel like maybe you need to charge them, and that kind of pre-qualifies your leads and people that actually, they won't come to you unless they actually suffer from the pain or that need that value proposition that you're offering. I mean, it's always tough, honestly, but if you want to take it back to Wuilt, I think just web page building is just a extremely commoditized service, unfortunately for them, and in a market where price sensitivity is extremely high, they need to come up with a new business model. But now, of course, I'm pretty sure they're all thinking about how can we actually bring them in and then get them to reach that moment of delight or offer and then once we get them hooked, how can we charge them money? It's it's not easy. Business development is not easy.
Yeah. And hats off to them because they're contrarians. They let go the ARR model against all the norms in the market today to pursue a new innovative business model. And I think they're brave and contrarian to do that. Well, now let's move to my favorite topic, which is secondaries. Jane, what's happening with secondaries?
Yeah, why sell a secondary stake in one company when you can just offload the whole portfolio, which is the case here. So Saudi-based Afaq Capital, they've completed the acquisition of an entire VC portfolio, being Falak Investment Hub, in what is being described as the region's first secondary entry and exit transaction. Now, this is still pending final regulatory approval, we should say as well. In terms of the portfolio itself, it was originally assembled by Hassan Ikram, who we had on the podcast recently, Ahmad, didn't we? Yeah, exactly. Kept that quiet.
We did, and he's coming in 2 weeks.
Oh, fantastic. Okay, we can grill him then.
back
We
in
can
2
grill
weeks.
him then.
I hope he was here today to talk about this, but
Yeah.
they're coming in 2 weeks' time.
Typical. In terms of the sort of portfolio itself, so deals are the details weren't necessarily disclosed in terms of this, but from what I can gather, it seems to span maybe 20 startups since about 2018, variety of different sectors. From what I can infer, it seems like they, on their website at least, felt like gives sort of an aggregate value of somewhere around $300 million kind of aggregate market cap for the portfolio, but I'm sure there was some level of discount applied to that in the transaction, but pretty novel, needless to say. Ahmed, I feel like we need to start with you for your reaction to this. It would be only fitting before we move on to the two alleys.
Okay, fair enough. Well, for the audience, just let's clarify something. There are two main types of secondaries. There's the direct secondaries, where someone comes and buys shares from a company or from a shareholder in a company. And there's the LP secondaries, where you come in and buy a portfolio or a stake of an LP from a VC fund. So it seems this is working on the LP secondaries part. And given that, I really appreciate what Afaq is trying to do, because it's an investment platform that's not only for institutional investors, it's also for accredited retail investors. So they offer that portfolio now to their accredited retail. So now retail investors have access to a VC portfolio when those individuals might not be wealthy enough to invest in a VC fund themselves as LPs, but now they have access to that kind of return, that kind of investments or asset class. That's what I'm thinking about. And in general, we're not seeing a lot of direct secondaries or even LP secondaries funds in the MENA region. In the US, there's a lot of them, Lexington Partners. We have Manhattan Venture Partners, Industry Ventures, and even Zen Equity pivoted to this model. There's a lot of companies focusing on secondaries funds. And I would dare to say some of these have outperformed primary VC funds because they come in shorter terms and they kind of return the same multiple, cash and cash multiple at the end of the fund term. So they might generate higher IRRs. Not all of them, but some of them did that. So yeah, that's my reaction so far. What do you think, Ali and I?
The more liquidity in the market, the better for everyone, right? You want more liquidity across all fronts, and that hopefully is a signal to other potential accredited investors, family offices, large institutions, to not just take a look at VC funds or secondaries in specific companies, but also in portfolios and LP positions. That also provides liquidity for their own LPs, for that could potentially invest in other ways. You could identify, as a new as a potential new asset class or let's say segment within the alternative investment world. I'm pretty sure you could identify a lot of, let's say, undervalued portfolios that you could come in and generate very healthy returns. So all in all, I think more liquidity across the spectrum, across the whole vertical, that's always healthy, I think, for everyone, and a good signal to other potential investors to take a look at other portfolio, other LP positions, and also creates liquidity for those that are, let's say, down the line, talking about asset managers and direct LPs as well.
Couldn't agree more with what Ali said. This is a financial innovation that I think started in private equity in the alternative space prior to year with continuity funds. But if you go back and you geek out a little bit on financial innovation, like even in the US, ETFs started by Vanguard sort of in the 70s, 80s. And that was a way of de-risking, kind of like stock picking, especially for retail investors. So, but would democratize kind of getting the gains of the entire index without having to have like specialty knowledge and stock picking, right? So this is a bit similar in the sense that you're taking a bucket of or a pool of assets that is usually not accessible, and you've already kind of de-risked a little bit because you have a better idea of what the value of that pool of assets are in the direction of travel, and then you can take that and you can slice it and dice it and have access to family offices, retail investors to be able to get the upside of this asset class. And there is great upside. The market has not grown for the last 10 years, it's in line probably with the stock market, right? It's probably higher. And I think that the trend is even going to be further going, even higher. Look at today, like the S&P, it's being pulled by the tech companies, right? So why not give exposure to less sophisticated investors to this asset class, while also unlocking liquidity in the market, which means that you can increase the velocity of doubling down on the earlier stage as well, right? So it's for me, it's a win-win.
Yeah, and there is Practical VC, a new VC firm that's focusing only on LP secondaries, and they talk about shortening the J curve. For them, it's not only for retail investors. What they target is institutional LPs, but they serve their LPs by buying portfolios of funds that have come to the end of their terms, and they get a really good discount. Although the VCs have already made 10, 20, maybe I don't know how many X's on their individual companies, and they're ready to sell because the fund term has ended, and they Practical VC and Industry Ventures, they come in, they buy that portfolio, and the wait for them is relatively shorter because these are mature companies now and they're about to get acquired or go public. Well, what do you think should happen in MENA to have more of a vibrant secondaries market? Do we lack regulations? Do we lack platforms, brokers, pricing transparency? What needs to happen in MENA to have more direct secondaries funds, LP secondaries funds, or even more secondary transactions that happen in parallel? And do we have any stigma around founders selling some of their shares during the rounds? I've heard some VCs say that it could be a red flag. I don't agree, but I would love to learn more about your opinions about this.
Let me tackle a few of those that give you kind of my take, right? But I think that awareness about the benefits of this is the first point. So we're doing that right now by just talking about it, and we need to talk about it more. So probably this this space needs also more space in terms of the events that we do and the talks that we do to progress the industry, and I think that capitalism means that people enter the space. I see an opportunity and, sort of a more of a blue ocean compared to maybe the more traditional models. So already we are seeing some folks start this, which I think is positive and great. And I think as a result of that, others will enter, like brokers and so on. So I'm less worried about that. I think it's more about, are we ready? I think we're ready. And I think that people will naturally enter this. That's kind of the magic of capitalism, right? The invisible hand kind of making things work. The last question or the last point that you talked about is interesting for me, which is founders being able to take some cash off the table. I think this is very important, but also it's a timing thing. So if to build something that's going to be an outlier, you need to be a little bit crazy. I think it's a really, really, really tough grind. And all of those folks that we're celebrating today, for example, probably have had very dark days. So I think that you need to balance that they need to have a sustainable life. But if they kind of already are sitting on millions and millions and millions, you might not have the drive to kind of do what's necessary, which is kind of this crazy year-on-year growth and developing new products and so on. So I think it's a matter of timing. I think once the life cycle of the business becomes a bit more mature, I think it's absolutely important for founders to start getting some of the economic benefit of that, not just paper money. But I think like earlier stage, up to Series B, I would say that is probably not, especially from the investor's perspective, where you need to kind of make sure that they're really fully focused on building something exceptional.
Don't you think that by releasing some of the stress, they would be a little bit more relaxed and they have a clearer mind to focus on growing their own company instead of, being stressed that they don't have enough cash to put their kids in college or pay the school fees of their kids?
I'd rather they get better salaries, right? So there's kind of two hats as a founder. As a founder, you are a shareholder, but you're also an employee, right? And sometimes you stop being an employee, right? You're not the best person to lead the company in there. So I think that generally you need to be paid well, and there's benchmarking for that. What is well? But for sure, you shouldn't be having to carry the stress of the business plus the stresses that you mentioned, right? Like, what I would say is basics, right? But I think if you're talking about, oh, I want to take some cash off and then I'm thinking about buying my luxury home in Saint-Tropez, no, I don't think you're going to be able to be busting a gut building a great business if you're talking to brokers in Saint-Tropez about buying
Yeah, I mean, I think totally aligned, right? That's typically how we would approach it as well, right? If it's the early years, obviously you want them to completely invested. If they need liquidity, yes, we don't want them to stress about anything else other than the business. So completely aligned there. In terms of, I think the first part of your question, which was infrastructure and what's needed to have a more vibrant secondaries market, right? I think, yes, CMA in Saudi Arabia, for example, is launching a lot of different crowd investment licenses, for alternative investments, for fixed income securities, for, private equity, for real estate. So there's definitely regulation there. There's a lot of different platforms. There's, companies such as Zest Equity, creating a platform and hopefully a secondary market for, VC-backed startups and other potential alternative investments as well. So yes, whether it's regulation, whether it's talent, whether it's software, and then also on top of that, of course, you need these, champions in the market, right? Where you could actually see successful case studies and a playbook would be also, and of course a playbook would be, let's say, built with time in terms of how do you, okay, if this is a direct secondary position, whether this is an LP position, whether this is the whole portfolio, how do we take a look at it? How do we assess it? How do we evaluate? Okay, these are all things that also would come in time. And once you have the know-how, once you have the market, once you have the infrastructure, once you have the regulation, you will have hopefully a very thriving secondaries market as well.
Just one thing to add there, which I didn't mention, which is unlocking the institutional investor pool. So if you look at pension funds, insurance businesses in the US, at the top of the funnel, they are really big players in this asset class. And I think that we still haven't unlocked that. And once we unlock that, those pools of capital exist and are very, very deep and rich in our region. Once we can get them to maybe allocate a percentage to this asset class and show them that it will just take this industry to another place.
Let me now flip the scene or flip the question and ask about how founders feel about this. If you're selling I mean, founders wanted this specific VC to be their, lead VC and support them and everything. And now that VC is selling the whole portfolio to someone else. How would founders feel about this?
I can give my own personal anecdotal views. And we've actually saw in my personal exit history, 3 of those have been secondaries. I've had 7 cash exits, so almost half. And all of those were fully supported by the founders because I've always been an early, usually first to fintech investor. And it's a long road, and I think founders, I've always been very close to founders, very empathetic with their journey. And they also, it's a two-way relationship, right? So they themselves have said, look, Ali, we want to do a solid. Would you like to take some cash off the table, right? And sometimes I'd say no. Like if I had more, I'd go. I'd put more. But sometimes it's like, what? Actually, it's good for the LPs also to get some money back. Can I take maybe position off, right? And I think that is really a function of your relationship with the founders. And I think founders empathize that you need to also return money at some point. But I think it's a two-way street because for the same, like we're saying this, they also need to have empathy from investors that at some point they should also be able to take cash off the table, right? So it's a kind of this 2 sides of the same coin, in my view.
Do they have a say in who you're selling to? Maybe they don't like that new entity.
If they're quite concentrated like investors and they have like a huge concentration and suddenly you're selling to somebody who's like a very different dynamic, I think that this could be a problem. I'm not sure honestly how other secondaries or whether this problem has been solved, but this is also a relationship game. You don't want somebody who's suddenly like on your board, owns maybe 15-20% of your company, being like not somebody that you would like to be associated with.
So yeah, I think from my end, I mean, obviously, I think most founders do have an understanding that VCs run close-ended funds, and ultimately there's a time horizon for their investments, and they need to exit. Obviously, the expectations I think from the founders typically, the first couple of years, once the VC comes in and maybe they sit on the board, and there's some expectations in terms of how much, to what extent can these guys add value, or the VC can add value, whether it's supporting them in subsequent rounds, hiring, entering new markets, whatever, more strategic support. But most founders don't expect VCs to stick around, for a very, very, very long time. That's number one. Number two, in terms of who we sell to, yes, I mean, I don't recall. I mean, for us, for all the secondaries that we have sold, it was never, to a company that wants, to destroy the startup, right? Because they see value and they're in for the upside for that company as well. And of course, they're here, they're coming in, buying our shares to see the success and further growth. Right? Maybe we come in at 10, we exit at 100, and then these guys are coming in at 100. Obviously, they believe that this is potentially a unicorn, right? So it never has happened where, unless, I mean, the ones that are typically tough are those that are, let's say, maybe it's a write-off within some of the shareholders, and they're trying to force an acqui-hire. There's not enough liquidity to further support the vision of the founder, which maybe they didn't deliver after 3 or 4 years, and then now they, either the company dies or they gonna get consolidated. But but this is, I mean, if we're talking about, let's say, direct stake from our end to another shareholder, it's not like they're coming in to completely change the company. It's typically maybe in distressed situations, and the distressed businesses, of course, there's a lot of different issues, and not just who am I selling it to specifically. So it's rarely does it happen, as you highlighted, that the founder is not aligned with the investor on this transaction.
I really enjoyed this episode. It's like, maybe because I'm interested in secondaries, but yeah, I really enjoyed it. Before we wrap up, a big thanks to Octa for sponsoring today's episode.
If you want to get paid faster, access financing, and automate your receivable process, head to weareocta.com. That is weareocta.com, and take control of your accounts receivable today.
Well, with that, thank you so much for joining us today, Ali and Ali. We really enjoyed the conversation. And thank you, Jamie, for bringing us all this news every week.
Thank you, guys. That was great.